TechByte Insight channel. Kindly subscribe. So in today's session, we will be discussing conceptual framework in accounting. Alright, let's talk about the conceptual framework in accounting. Think of it as the architect's blueprint for constructing a sturdy financial building. The conceptual framework is like the master plan that guides the entire accounting process. So, let's break it down in a conversational way. Imagine you're about to build a house. You wouldn't just start hammering nails and stacking bricks randomly, right? You'd need a solid plan, a blueprint that ensures your house stands tall and meets all your needs. In accounting, that blueprint is the conceptual framework. So, what exactly is this conceptual framework? It's like the backbone of accounting, providing a set of principles and guidelines that make sure financial reporting is consistent, reliable, and useful. It's the rulebook that accountants follow to create financial statements that truly reflect a company's financial health. Now, think of it as a set of guiding principles. Picture a compass that always points north. Similarly, the conceptual framework points accountants in the right direction when they're making decisions about how to record and report financial information. It keeps everyone on the same page, speaking the same financial language. One crucial aspect of the conceptual framework is its role in setting standards. Just like traffic rules keep everyone on the road safe, accounting standards derived from the conceptual framework ensure that financial reporting is clear, consistent, and comparable. It's like having a universal language for financial communication. Now, let's talk about the key components of this framework. One major pillar is relevance. The information should matter and make a difference to the users. It's like ensuring that the details in your house plan are relevant to your needs, like having a kitchen that suits your cooking style. Another key component is reliability. Imagine building a house with shaky foundations, not a good idea. Similarly, accounting information must be reliable, trustworthy, and free from bias. It's like making sure your financial house won't collapse under scrutiny. But here's the interesting part, the conceptual framework isn't set in stone. It evolves and adapts, just like architectural designs change over time. As the business world and financial practices evolve, the conceptual framework gets updated to stay relevant and effective. In a nutshell, the conceptual framework is the guiding light for accountants. It's the compass, the blueprint, and the rulebook that ensures financial reporting is not just a random assortment of numbers but a structured, reliable story of a company's financial journey. It's the foundation that makes accounting more than just numbers, it's a language that speaks volumes about a business. Let's start by explaining what conceptual framework is. The conceptual framework in accounting is a theoretical structure that provides a foundation for establishing accounting standards and principles. It outlines the underlying concepts and principles that guide the development and application of accounting standards. The primary goal of a conceptual framework is to enhance the consistency, comparability, and understandability of financial reporting. For the purpose of this study, we would concentrate on the scope of the conceptual framework, which was introduced in September 2010. Although, it has been improved in 2018. At the end of the session, I will introduce the current conceptual framework scope with you. Now back to the scope. There are 6 components of the conceptual framework. These are: 1. The objective of financial reporting. 2. User groups of financial statements. 3. Assumptions underlying financial statement preparation. 4. The qualitative characteristics of financial statements. 5. The definition, recognition, and measurement of the elements from which financial statements are prepared. 6. The concepts of capital and capital maintenance. Now let's take each component. The first conceptual framework is objective of financial reporting. The objective of financial reporting is to provide information about the financial position, performance, and changes in financial position of an entity that is useful to a wide range of users in making economic decisions. So entities use statement of profit or loss to analyze the performance. They use statement of financial position to assess the financial position of the entity. And finally, they use statement of the changes in equity to analyze the changes in financial positions. The second item on the conceptual framework is users groups of financial statement. This refers to groups that uses financial information for various purposes. This covers shareholders, management, investors, trade payables, trade receivables, government and government agencies, general public, etc. My previous video has explained the users of accounting information and what they need the information for. The third item on the conceptual framework was assumptions underlying financial statement preparation. There are two main assumptions underlying financial statement. These are going concern, accrual basis. Going concern is an accounting term for a company that is financially stable enough to meet its obligations and continue its business for the foreseeable future. Certain expenses and assets may be deferred in Certain expenses and assets may be deferred in financial reports if a company is assumed to be a going concern. And accrual recognizes business revenue and matching expenses when they are generated, not when money actually changes hands. The fourth item on the conceptual framework was qualitative characteristics. Qualitative characteristics refer to the characteristics that make financial information provided in financial statement useful to users. Qualitative characteristics has been categorized into two components: fundamental qualitative characteristics, relevance, materiality, and faithful representation. Enhancing qualitative characteristics, timeliness, verifiability, understandability, and comparability. My next video will explain in details each of the fundamental qualitative characteristics and enhancing qualitative characteristics. Now let us talk about the elements of financial statement. According to the conceptual framework, there are 5 main elements of financial statements. These are 1. Assets, 2. Liabilities, 3. Equity, 4. Income, 5. Expenses. These concepts would be further explained in the next video. The concepts of assets, liabilities, equity, income, and expenses have been explained in the next video. The next item on the scope of conceptual framework is the definition, recognition, and measurement of the elements of financial statement. Measurement is the process of attributing monetary value or amounts to the elements of financial statements and how they are recognized and reported in the financial statements. The framework provides 4 measurement bases. Historical cost. In accounting, the historical cost of an asset refers to its purchase price or its original monetary value. Based on the historical cost principle, the transactions of a business tend to be recorded at their historical costs. Current cost. The current cost of assets is their current value, or what it would cost to replace them at this time. The drawback to using the current cost rather than historical cost approach is that cost estimates may be difficult and costly to obtain. Realizable value. A realizable value in accounting is used in the context of inventory. It is the value that a set of assets are expected to generate in total. Present value. Present value is the current value of a future sum of money or stream of cash flows given a specified rate of return. Present value takes the future value and applies a discount rate or the interest rate that could be earned if invested. Now let's move on to the final item on the scope of conceptual framework. This is the concepts of capital and capital maintenance. This explains how entity defines the capital that it seeks to maintain. The 2 main concepts of capital maintenance have been indicated. Financial capital maintenance. A profit is earned only if the financial amount of the net assets of the entity at the end of the period exceeds the financial amount of net assets at the beginning of the period. Physical capital maintenance. A profit is earned only if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity of the entity at the beginning of the period. Note: physical capital maintenance uses current cost. Financial capital maintenance uses historical cost basis of measurement. This brings us to the end of the lessons. The channel is Tech Byte Insight. Kindly subscribe. See you in the next lesson. Thank you.